Well, good afternoon, everybody. This is Brian Manier with Keystone Financial Group. I hope that everybody is having a great summer so far. It's hard to believe it is already approaching July 4th, which we'll be celebrating tomorrow. So welcome to our monthly webinar. I'm so glad that you were able to take time and listen in. We got a really interesting topic today. We're going to be talking about Roth IRA conversions, and this is something that has gained some popularity over the last few years, where more and more people have had some interest in doing what they call Roth conversions. And the popularity of just Roth IRAs in general, since they first started, has become more and more popular. So this is something that we feel is an important topic to discuss, and we're really excited to share a little bit about Roth IRA conversions and how those work. So as we get into this today, we're going to first introduce just Roth IRAs in general and how they work. So Roth IRAs have been popular retirement savings vehicles. They were introduced first in 1998. 2017, there's been approximately 24.9 million, or I would say around 19.7% of U.S. households that have had Roth IRAs, and the source of this is the 2018 Investment Company Fact Book. Roth IRA contributions are made on an after-tax basis. So the way that works is there's no upfront tax benefit. So if you're going to contribute to a Roth IRA, you're doing this on an after-tax basis. You're not getting any tax deduction if you contribute to a Roth IRA. Qualified distributions are entirely free from federal income tax. This is why an individual or someone would contribute to a Roth IRA, is because of the tax-free distributions that you would take from those. In this particular presentation, we're going to discuss some recent changes to federal law that make converting a Roth IRA easier, but we're going to go over some IRA basics before we do that. And I want to caution you, there's some different rules that may apply for state tax purposes. So let's talk a little bit about traditional IRAs versus Roth IRAs. Now, when you look at a traditional IRA, or what they call an individual retirement account, when I teach and do Social Security workshops, or I teach retirement classes, what I realize and talk to the classes about is that most of the money that people have, or most of the wealth that I have seen as a financial planner, has been through 401ks. And as people leave jobs and they transition from employer to employer, a lot of times what happens is they'll move that money from their 401k plan that they had with their previous job, and a lot of times they'll either move that to their current 401k, or they'll move that to an IRA. So there are a lot of individuals that I work with that have current IRA accounts outside of their 401k plans. So practically anyone can open and make contributions to a traditional IRA. There's only two requirements. You have to be under the age of 70, and you have to have taxable compensation. Now, whether or not you can deduct your contributions, though, depends on different things like income, filing status, whether you or your spouse is covered by an employer retirement plan. So there are circumstances that you can actually fund an IRA and get a tax deduction for that. It would be a pre-tax contribution. Even if you're not eligible to deduct your contributions, you can make what's called a non-deductible contribution to a traditional IRA. And this is important. We're going to talk about this a little bit later, but non-deductible contributions are often called after-tax contributions. And this is another way that you can make contributions to your traditional IRA. Distributions are required once you reach 70 and a half, so you have to take those. Those are going to be subject to federal income tax, except for those that are after-tax contributions. And then it's understand that distributions prior to the age of 59 and a half. So if you take a distribution prior to age 59 and a half from your IRA, those are going to be subject to a 10% tax penalty. Okay, now if we touch on Roth IRAs, you can make annual contributions if you have taxable compensation there's no age limit for that. You can be as old as you want, and you can still make those contributions to that. The ability to contribute depends on income level and filing status. We're going to talk about those income levels a little bit later in the presentation, but in order to actually fund a Roth IRA, you have to fall within a certain income level. All contributions are after tax, so there's no upfront deduction, which we mentioned before. Those are going to be after tax dollars. Qualified distributions are entirely tax-free from federal income taxes. Again, the reason why people contribute to their Roth IRAs. And then for non-qualified distributions, earnings are subject to a federal income tax, and possibly a 10% penalty may apply if you're under 59 and a half. We're going to talk about those qualifying events. No lifetime required distribution. So when you talk about RMDs, I work with individuals that even if they have enough income, let's say from Social Security and let's say from a pension, if you have an IRA, you have to start taking distributions at the age of 70 and a half. A lot of times people don't want to do that. With a Roth IRA, you don't have to take any type of required distributions, which is the reason why people do like the option of the Roth IRA. And then when you look at both of them, both the traditional and the Roth IRA, both of these are going to grow tax deferred. Now the difference is when you take the Roth, that's going to be tax free, whereas the IRA, you're going to pay taxes on that entire distribution, but they both grow completely tax deferred, and then the Roth tax free. So let's talk about how the Roth tax-free qualified distributions work. So if you meet certain conditions, your withdrawals from your Roth IRA are going to be completely free from federal income tax, okay? Now, for a distribution to be qualified, it's got to meet a couple different requirements. The first is that you have to satisfy a 5-year holding requirement. We're going to talk exactly how that specifically works. In addition to that, you have to have a qualifying event. So generally, you have to reach age 59 and a half before making that withdrawal. Now, there are some other qualifying events. So if you haven't reached 59 and a half, you can still have distributions that will be tax-free if you satisfy the 5-year holding requirement and you make a withdrawal because of either a disability, or if you're a first-time homeowner and you're purchasing that home, it's limited to the $10,000 lifetime from your IRA. And then payments after your death are also qualified if the 5-year holding period is satisfied. And again, we're going to talk about exactly how that works. So for the 5-year holding period, it begins on the first day of the tax year, which you first make the contribution, whether it's an annual payment or a rollover conversion to any Roth IRA. That's how it starts. So the 5-year holding period ends after 5 calendar years. Okay, so you only have to have one 5-year holding period for all of your Roth IRAs you own for calculating qualified distributions. Now, however, Roth IRAs you inherit are subject to a little different rules, and we are going to talk specifically about that. It applies to your beneficiaries after your death as well. Okay, so spouse beneficiaries, you have additional options. Your spouse can roll your Roth IRA proceeds into his or her own Roth IRA. And if your spouse is your sole beneficiary, your soul can also treat your Roth IRA as his or her own. In either case, your spouse will be able to use either your holding period as his or own, whichever is more favorable. So what that means is that the 5-year holding period will begin January 1 of the tax year your spouse first established any Roth IRA, or if earlier, January 1 of the tax year for which you first established. So they're going to look at whichever is earlier and give you the benefit of that. Okay. Now remember, you generally have until April 15th to make the annual contribution to an IRA for the previous tax year. So for example, for 2018, you could have made that contribution for 2018 up to April 15th of 2019. So it does the way that you can contribute does allow to do that even after the next year started. So so for example, if you make your contribution to a Roth IRA on April 15th of 2020 next year, and you can then designate that contribution for the 2019 tax year. And what that does then is the 5-year holding period actually begins January 1st, 2019, even though you made that payment for 2020. Okay, so let's look at some specific examples of how that works. So let's look at first of this example for someone that, let's assume you're 60 years old when you set up your first IRA, and you set that up actually on December 31st of 2019. So let's say you're going to first establish a new Roth IRA, and you're going to do it at the end of this particular year by converting a traditional IRA to a Roth IRA. Well, you must have a qualifying event and satisfy the 5-year holding requirement, as we talked about earlier. Here, the qualifying event has occurred, which is what? Which is that you've reached 59 and a half. Now, what would happen is the 5-year holding period is going to begin January 1st of this year, 2019, even though you didn't establish that Roth IRA until December 31st. So that's a nice benefit that it lets you go back to the beginning of this year. So the 5-year holding period then ends December 31st, 2023. You'll then be able to get a tax-free distribution from that Roth IRA and any Roth IRA that you subsequently establish after that date. Okay, so that's the 5-year rule. Even if you do it sometime this year, it's going to start back at the beginning. The clock starts in January 1st of 2019, and then you'll be able to take those tax-free withdrawals on December 31st, 2023. Okay. Let's look at another example. Let's look at someone who's a little bit younger. Let's say they're age 35, and let's say that they established their first Roth IRA on June 1st of this year. So they did that last month by making a rollover from a 401k plan, and they did that to a Roth IRA. Well, to have you got to have the qualifying event. They're not 59 and a half yet, and they have to satisfy the 5-year holding period. Well, the 5-year holding period begins when? It's going to begin at the beginning of this year, even though they didn't start it until June 1st of this year. The 5-year holding period is going to end when? Again, just like the other one, December 31st, 2023. But the tax-free qualified withdrawals available from this Roth IRA and any Roth IRA are not really going to be able to take place until 2043. And the reason for that is because the qualifying event is that they have to obtain the age of 59 and a half. Okay. After 2023, again, you can have some other qualifying events, whether there's some disability, you pass away, or if you're a first-time homeowner, up to, again, $10,000. So if you didn't have those other qualifying events, even though that 5-year time frame had passed, you do have to be 59 and a half in order for that other qualifying event to occur. And you can see that on the timeline there. Okay, let's look at one more example. In this example, let's say that you inherit a Roth IRA and you inherit this from your mother in 2019, but your mother establishes the first IRA in 2016 by making a regular contribution. So you must have a qualifying event, satisfy the 5-year holding period, and the way that's going to work is the qualifying event is your mother's death. So the 5-year holding period doesn't start when you inherit it. It actually starts when she began it, which was in 2016. So they're going to go back to January 1 of 2016. The 5-year holding period then ends when? December 31st, 2020. And so the tax-free qualified withdrawals are now available from the inherited Roth IRA anytime when after that 5-year period, which is December 31st of 2020. But the good thing is that 5-year period doesn't start when you inherit it. It actually started when the person who established that Roth IRA. So let's talk about non-qualified Roth IRA distributions, because we just talked about what qualifying events mean. What about non-qualified distributions? How do those work? Well, what those basically mean is if you haven't established a 5-year holding period or you don't have the qualifying event, which we talked about the three different events. So what happens is if you take a distribution from a non-qualified, or if you're taking from a non-qualified distribution, your contributions still come out tax-free. Your contributions come out first, and then the taxable earnings come out last. And what happens is when you take those distributions, the earnings are then subject to income tax and a 10% penalty unless an exception applies. So what that basically means is if you have growth on that Roth IRA, you take a distribution, you take more than what you have put into it, so more than your cost basis. Anything additional to that, unless there is a exception, any earnings you're going to have subject to income tax and a 10% penalty if it's a non-qualified distribution. Okay. So now that we know how that works, let's talk a little bit about ways that you can fund a Roth IRA, because there's different ways that you can fund it, and there's certain rules that you have to follow. So the first way that you can do it is what's just basically making a regular annual contribution. If you qualify based on your earnings, we're going to talk about what those earning limits are, but if you do fall into those earnings limits, then you can make regular annual contributions. The second way that you can do it is a rollover from an eligible employer plan to a Roth IRA. So that's another way that you can do it. And then the third way is what we call converting a traditional IRA to a Roth IRA. And we're going to talk about the first two methods later on, but I want to first focus on talking about how to do those conversions, because that's something where a lot of people, especially if they're in their later years of retirement, and they know that they're not really going to contribute to a Roth IRA at this point in time. But is there a way to convert? So we're going to talk about how that specifically works. So let's talk about what do you do converting a traditional IRA to a Roth IRA? Well, it's taxed in the year of the conversion if you took a withdrawal and converted it over. Now, the good thing about that is, and the benefit is, there's not a 10% early distribution, even if you're younger than 59 and a half. Okay, so when you convert your traditional IRA, you're going to be taxed as if you took that withdrawal when you convert that into a Roth. Now, why would you want to do this? Why would you want to pay taxes on this now? And as I mentioned earlier, what you're basically doing is the trade-off is you're paying taxes now with the hope and the expectation that the later distributions from your Roth IRA will be qualified and therefore tax-free. One of the things that we always ask our clients is, where do you think taxes are going to go? Do you think you're going to be in a higher tax bracket? Do you think taxes are going to increase? Or do you think taxes are going to be lower? And depending on how you answer that question, that might be one of the reasons that you do want to move the money and pay the taxes now. In addition, you also have the freedom where you don't have to take distributions if you don't want to. Okay. You can also convert simple IRAs. There is a 2-year waiting period, and SEP IRAs to Roth IRAs as well. So if you're a business owner, let's say, and you have simple or SEP IRAs, these are different accounts that you can move into those. Now, you can't convert SEP and simple IRAs that you've inherited, but if you have ones that you've set up and you want to move those into your own Roth, that is a possibility. Okay. You can convert amounts from traditional IRAs to Roth IRAs in specifically 3 different ways. The first is a rollover. You receive a distribution from your traditional IRA, then you roll it over into a Roth within 60 days after the distribution. Pretty much how you would do a typical rollover from like a 401k over to a traditional IRA. You can also do what's called a trustee-to-trustee transfer. You can direct the trustee of the traditional IRA to transfer an amount from your traditional IRA to the trustee of your Roth IRA. And then you can also do what's called a same trustee transfer. And if the trustee of your traditional IRA also maintains your Roth IRA, then you can direct the trustee to simply transfer an amount from your traditional IRA to your Roth IRA, or redesignate your traditional IRA as a Roth IRA. So those are the 3 different ways. The way that we help individuals is mostly that first one, with that rollover that you're just making from your traditional into a Roth IRA. That's the one that we see most common. So how do you calculate the conversion taxes? Okay, well, as I said, if you're going to make a conversion, you're taxed as if you've made a withdrawal from your traditional IRA. But this is the most important part of this, is the 10% early distribution penalty doesn't apply to Roth conversions, even if you haven't attained age 59 and a half. So let's say that you have a 401k and you're younger and you want to convert those to Roth IRAs, you're allowed to do that. Now, you do have to be careful, because if you make a non-qualified withdrawal of converted funds from your Roth IRA within 5 years after the conversion, what's going to happen is the IRS is going to recapture that early distribution penalty unless you're 59.5. But again, that's if it's a non-qualified withdrawal of converted funds. And we touched on what that means earlier. Okay? So as we're looking at the calculation of the conversion taxes, if you've made only deductible contributions to your traditional IRAs, then what's going to happen is the entire amount that you convert is subject to income tax. All right? But if you've made any non-deductible, that is after-tax contributions to your traditional IRA, the calculation is a little more complicated. So again, this is a situation where, let's say you don't qualify, you've made IRA contributions, but they're not considered pre-tax, they're just after-tax dollars into your IRA, then that's going to be a little bit more complicated. So we're going to talk about how that specifically works. So if you've made non-deductible contributions, and I don't see this often where people make actual non-deductible contributions to their traditional IRA. Most times people do it because it's pre-tax. But in the event that you have done this, then anytime you take a distribution, your withdrawal is treated basically in a pro rata amount of taxable and non-taxable dollars. So since conversions are taxed the same as withdrawal, the same rules are going to apply. If you've made an after-tax contribution to your traditional IRA, part of your conversion will be taxable, and then the other part is going to be non-taxable. And so what this means is that you can't convert just the non-taxable portion to your traditional IRA to wind up with a tax-free conversion. That'd be nice if that was possible, but that's not what this is intended to do. You can't just convert the non-taxable in the traditional to the tax-free conversion. Okay? So if you have a traditional IRA with taxable and non-taxable funds, what you may be thinking is, you know what, why don't I just transfer the non-taxable portion to a separate IRA, and then I'll convert that new IRA to a Roth IRA, and then guess what? I can just avoid all the conversion taxes whatsoever. That's a great thought, but it's set up where you can't set it up in that manner. So what basically happens is whenever you take a withdrawal from any traditional IRA that you own, you're required to aggregate that IRA with all other traditional IRAs you own. So they're going to include SEP, any simple IRAs, and when you calculate the taxable and non-taxable portion of the withdrawal, this applies to conversions as well. So you got to aggregate all of those before that you can, so you figure out exactly what the taxes you're going to pay on that. So let's look at an example here. So you own two IRAs, and we'll clearly call IRA 1 and IRA 2. IRA 1, you can see there, it has a balance of $100,000. It contains the deductible, all the deductible contributions you've made plus any earnings that you see there. Therefore, IRA 1 holds only taxable dollars. If you look at IRA 2, it has a balance of $20,000, and it contains only after-tax contributions. So these were not taxable, tax-deductible contributions. And so it's only non-taxable dollars. So if you convert IRA 2 to a Roth, what happens here is you'll have a little over $16,000 of taxable income, even though you've only made after-tax contributions to that IRA. And the reason for that is because 5/6 of the total balance of your IRA is taxable, and 1/6 is non-taxable. So any withdrawal or conversion that you make from any traditional IRA you own will also be 5/6 taxable and 1/6 non-taxable. Okay, so the way that it works is you aggregate all of the IRA, simple IRAs, and everything that you see here, and the total balance of that is what? Is $120,000 if you aggregate those two. Then what you do is you determine the percentage of the total that is taxable. In this example, you get that percentage by dividing the taxable balance, which is $100,000 by 120, right? So you take the amount on the left and you look at the aggregate, which is 120, and that amount is 83.3%. Then what you're going to do is you're going to multiply that amount of the withdrawal or conversion by the taxable percentage. So if you convert IRA number 2, that $20,000, you would simply multiply 20,000 by what? The 83.3%. and you arrive at a taxable amount of $16,667. This is a simplified example. There's an IRS form. It's actually Form 8606. It contains a worksheet that guides you through this exact calculation. But the point that I want to make here is you have to look at all of the IRAs that you have. You have to aggregate them. Some may be taxable, some may be non-taxable, but this is the way that you would calculate the conversion taxes. Now, who can convert to a Roth? Can anybody do it? You may be saying, hey, I would love just the idea of having some flexibility of not paying RMDs. I like the ability of paying the taxes now and not have to pay them earlier. Well, before 2010, and for those individuals that were trying to do that then, you weren't able to do the traditional to a Roth if your income exceeded $100,000, or if you were married and filed separate federal tax returns. There was very limited amount of individuals that could do this. But with changes to the federal law, now anyone can do this from a traditional IRA to a Roth. So after 2009, it doesn't matter your income limits and it doesn't matter your marital status. Now there is one exception, and that's if you inherit a traditional IRA. You can't then convert that inherited IRA to a Roth. There's special rules that also apply to spouse beneficiaries, but if you're a surviving spouse and you inherit a traditional IRA, you can roll those funds into your own traditional IRA, and then what you can do is you can make that Roth conversion. So if you are the surviving spouse and sole beneficiary, you can also treat the inherited IRA as your own and then make that conversion. So those are some of the rules apply to inherited IRAs. Okay. What about converting your employer plan to a Roth IRA? So this is the method we talked. The second method of funding a Roth IRA is through a rollover from an employer plan like your current 401k. And what we see is these rollovers are also commonly called conversions, and they're subject to many of the same rules as traditional IRA to Roth IRAs. So when you receive a distribution from your 401k or other plan, your employer is required to tell you whether the distribution plan is eligible and to be rolled over. And if it is, you have the option of rolling all or part of that distribution to an IRA, Roth, or traditional. And if you roll the distribution to a Roth IRA, the amount you roll over, except for any tax contributions you made, will be subject to federal income taxes. and that's really important to know. But just like any traditional IRA conversion, anyone can roll funds to a Roth after 2009, regardless of income limits and regardless of marital status. Even a non-spouse beneficiary can roll inherited employer dollars to a Roth IRA, but only in a direct rollover. And then as you see here, rollovers from employer plans can be complicated, and the reason for that is they can have some tax implications. So you just got to make sure that you understand all of your options, including any fees and penalties that may apply and any special tax rules that may be available to you before you take action. So you just want to make sure that you research and you want to make sure that you get all the information, but it is good to know that that is a possibility if you want to move some of those funds into a Roth IRA. Okay? So how do you fund annual Roth contributions, or what are some of the rules that you can apply? Well, number one, in any given year, at least they changed it this year, you can contribute up to $6,000 to a Roth IRA. And if you're over the age of 50, you can make an additional, what they call a catch-up contribution of an additional $1,000. So if you want to contribute $7,000 to your Roth IRA in 2019, you can do that. Annual contributions, they can be limited depending on the income level, and you can see the different income levels on the chart there. So if you're single and you make over $137,000, you're not going to be able to contribute to a Roth IRA. If you're married, following jointly, a qualifying will where you can see that anything over $203,000 that you make, you wouldn't be able to qualify to fund a Roth IRA. So if you wanted to have a Roth IRA, what you have to do is what they call the Backdoor Method to fund annual Roth contributions. So if you can't contribute to a Roth because of your income limits, you can contribute to any traditional IRA as long as you're under the age of 70 and a half. And then what you can do is you can convert that traditional IRA to a Roth, regardless of, like we talked about, income, marital status. You can make non-deductible contributions initially to a traditional IRA. So you may not qualify to have a tax write-off or a tax-free pre-tax situation, but you can make non-deductible contributions to that traditional IRA, and then you can then immediately convert those to a Roth IRA. Again, you're going to remember, though, the thing of it is you have to aggregate all your IRAs when you calculate the taxable portion of the conversion. It's not just the amount that you contributed that year. You have to aggregate everything in order to figure out what that tax consequence is going to be. Okay. Now, is this right for you? Let's look at some of the advantages to doing a Roth conversion. It's beneficial if you expect to be in a higher tax bracket when you take payments, right? Do you want to pay the taxes now or later? And a lot of that is depending on where do you think taxes are going to go. Qualified distributions, they're tax-free, and they won't impact your Social Security. So one of the things that I teach my Social Security classes is there's a couple different scenarios that don't, what they call the provisional income, which impacts how much you're going to be taxed on Social Security. Well, Roth IRAs don't impact that, so that's a really big advantage of taking distributions to live off of a Roth IRA. It may not have an impact, and you may get out of paying taxes on your Social Security benefits. It just depends on what that provisional income is going to be. Lifetime distributions, they're not required, so you don't have to take those RMDs at 70.5 like you do for traditional IRAs, and then you may be able to leave more to your heirs, income tax free, versus if you inherit a traditional IRA, then you're forced to take distributions and you have taxes that you have to pay on those distributions. Okay, but what about the trade-offs? So like anything, everything has its advantages and everything has its trade-offs. Well, the trade-offs may be that it may not be appropriate if you expect to be in a lower tax bracket, because maybe if you're in a lower tax bracket after you stop working, you may be better off paying the taxes later. If you pay taxes now, it may have a potential negative impact on your Social Security. It may bump you into a higher bracket. And if you understand how the Social Security brackets and taxes work, there is a possibility that could happen. Using IRA funds to pay conversion taxes may have some drawbacks, and it may not be appropriate if you need to use the funds sooner rather than later. There's a risk of future law changes. We don't know what's going to happen with those, and the state treatment, tax treatment may differ. So it's more or less the unknowns that we don't know that this could be negative. But I think for a lot of people, they do feel that the conversions could be a good strategy for them. Covered a lot of information today, and we talked about this really quickly, but hopefully this was enough where you got some information to help you understand how these conversions may work. And what we would love to do is, if you feel like this is something that would be of benefit to you, or you want to talk to the advisor that you're working with here, give Rose a call. Many of you know her. Give her a call there. You can call her or email her. Feel free to go to our website, but we'd love to talk to you a little bit about how these work and if they can be beneficial to you. As always, we enjoy doing these monthly webinars. So glad you took the time to be a part of this today. I want to wish you a great and happy and healthy 4th of July holiday, and we look forward to seeing you on our next webinar. Thank you so much, and enjoy the rest of your day.